Hey everyone, how you doing today? With Greg Dickerson, my first expert, talking about building new homes. And what we're going to do in episode number 3 is really take the conversation from episode number 1 and 2 and transition it to the biggest part of the single family home market, and that is existing home sales. So how you doing, Greg?
Doing great, Michael. How about you?
Oh, I'm doing well, man. I really appreciate your time. You are my expert builder, developer, ground up, all of it. I just had to talk to you about this. We're going to transition this third conversation to what does it mean for existing home sales, right? The first two conversations have been about, okay, new asset class, new homes being sold off to deep pockets. But you and I both know when we look at sales, the majority, 85% of them are older homes, right? It's called existing home sales for a reason. So what does all this mean for existing home sales, you think?
Well, right now, really nothing because there's just no inventory at all. A lot of the new builds that we're seeing, there's a lot of competition for those because they can't, the builders can't keep up with demand. What we were talking about before, the for rent product isn't really going to affect the resale market because that's not even coming online. They're not even going to be considered comps necessarily, tracked as comps because it's a
Yeah.
different type of an asset sale. So it'll be really interesting to see how appraisers look at those package sales like that, if they can even, we can get the information from the tax records, but I'm not sure how that even records,
Yeah, I
if they
don't think it'll
record it
be I don't think it'll
individually.
be a comp. Yeah, it'll be the package, I'm pretty sure.
Yeah, it'll be pretty interesting to see how they actually record that at the municipal level, for real estate acquisition transactions,
Yeah.
that
Tax basis and all
if
of
they
that. Yeah.
track it individually. But as far as the resale market goes, new construction would typically, so normally the way it worked would be, if there was no inventory, then you build. And
Hmm.
typically you could build cheaper than you could buy when there's limited inventory. But
Correct.
what's going on now is that they're kind of outpacing each other. I don't know what's cheaper now, whether it's cheaper to build or buy. It's probably, they're both about right at the same,
Oh,
because
exactly.
construction costs
Yeah.
have gone through the roof. Usually construction costs remained in check. So it would be cheaper to build than buy when inventory levels were down in resales. Yeah, because there was just nothing out there. So existing home sales prices would go up and your construction costs didn't. What we've seen this time, primarily due to the pandemic and supply chain constrictions and labor force issues,
Hmm.
construction costs have shot through the roof. So I don't know for single family homes in most areas if you can build cheaper than you can buy right now because the prices are going up on that new construction just like they are on resales.
Yeah, this is something I wanted to talk to you about because none of my other experts would have experienced this. Is they're talking about 1,000 board feet, I think is what they call it.
Mm-hmm.
It costs over $1,000 or $1,100 now, and historically speaking, it's always right around $300, right? So that's
Mm-hmm.
that's a 300% increase, and then you add on top of that wage inflation because again, we lost a whole thousands and tens of thousands of skilled construction workers in the last crisis. They went off and did other things, trucking and shipping, and they're not coming back. So you have 3x input costs and a wage problem. Yeah, it's probably cheaper to buy existing homes and remodel today in lots of areas, I would assume.
Yeah, even with all the competition, and it's funny too because there are houses that aren't selling even in the hot areas. I made a
Mhm.
video about it the other day, that build it and they will come doesn't always work. It's got to be the right thing in the right area at the right price for the right market and the right customer. And you can look in your market right now, and I'm sure you can find
Oh yeah.
100 houses or more that are on the MLS that haven't sold.
Oh,
So
for sure.
not everything is selling, not everything is getting bid up, so it's really interesting. But to your point, in terms of construction cost escalations, I build houses in batches, when I can find the land. And the last batch I built, I saw houses, they were only a few months apart, but construction finishing,
Mhm.
a few months apart, costs were up like 5 to 10% on each house
Oh wow.
because every time I turned around, roofing was going up again, concrete was going up again, insulation, lumber was kind of in check at that point, and lumber just recently over the last year or so just started going through the roof. Now you've got issues with mechanicals, appliances,
Yeah.
plumbing, and then the labor cost. That's the big one. Electrical, plumbing, HVAC. If anybody's watching and you want to take advantage of this economy, become a plumbing, electrical or HVAC contractor.
Exactly.
Those guys are raking it in.
Yeah, no college education required. Go get a trade.
You got to know what you're doing, but
Yeah.
yeah, you don't need a degree. You don't, you need to get certified, licensed, take your
Hmm.
test, all that kind of stuff.
For
So
sure.
there is some education, obviously, component to it, but especially plumbing, man, that's one of the easiest trades in residential that's making the most money right now.
Yeah. We're really what I want this third conversation to be about is I said about a year ago, and I'm going to say it now again, that I think when you look over this decade, right, when you're through this decade and you look in the rear view mirror, if that makes sense, right? So you fast forward and then rewind. The single family home market is going to prove to be one of the best assets to own, right? If you get in now, you have remarkably cheap debt. I think debt's much more expensive in 5 to 10 years than it is today. You have this juxtaposition with, okay, people want space. Maybe we go renter nation, which we'll talk about in a minute. But again, if you're the owner of the asset that more people want, inflation, supply demand means, existing home sales, again, to quality in the right area, they got to go up in value, right? And again, if we become a renter nation, why is that? Well, that's because the single family home is too damn expensive to buy, which happens in some European countries, right? I think it was Switzerland, I think I was in, where like 80% of the homes, not apartments, 80% of the homes were owned by insurance companies, right? We could get to that level. I mean, I hope.
Yeah, people could get priced out of the market, but that's only if the rates remain low like they are, with demand like it is. And see, that's the thing. As soon as rates go up, the values come back down. So, if we see rates get back up into that 4 or 5% range, that's going to significantly affect the values of housing and the demand for it, because again, it's an affordability play.
Oh, it's without a doubt, right? Big thing in my book was affordability index. It tells me when to get in, get out. But I want to play with that just a little bit, because one of the things we see with these deep pocket investors is they're not borrowing money, right? Right. So, they buy, 35 or 32 million, whatever, homes in Texas. They're not going to borrow that money. So yeah, if rates go up, it hurts mom and dad, right? My affordability, I can't pay it, but maybe that just forces me to become a renter. And maybe we go from a 68.5% ownership to a 65 and a 63. And what's the answer? Well, maybe we all start renting from insurance companies and hedge funds, and because the demand's still going to be there, I think, to have space, I think.
Yeah. Yeah. And, they're looking at the cap rate play. So they're not looking necessarily at appreciation. And, they're obviously assuming you're going to get some level of appreciation on those assets, but it's more of an existing in place cash flow play.
For sure.
And, patient. And that was the same play that was made back in 0809 when housing was cut in half because interest rates went up, all that stuff was happening. Same investment funds came in, bought existing homes, and then sat on them for 4 or 5 years and peeled them out. And there was different levels of that being done. You hear the stories of people that, raised money and bought 20, 50, 100 homes, sat on them for 4 or 5 years, and then, sold them off individually and doubled or tripled their money.
Yeah.
So, those types of things have been happening for a while. But, the interesting thing is, you look at their alternatives. Okay, I can buy an apartment complex at a 3 or 4 cap, and I've got this asset that's not going to appreciate. I can buy houses at the peak of the market at the top. That's not really going to appreciate, but they're getting depreciation. They're getting long-term income. They're getting a return on their capital that they don't have to worry about, moving. And I think, again, it's a small fraction of the market. So it'll be interesting to see how it grows and how it expands.
Yeah, I think, again, I think when you go, like, you fast forward and you look back, right? If it's true, the numbers I've seen that these folks own 2% of single family homes as rentals. I mean, what could it be in a decade? It could be 10%. Yeah. I mean, it could be. I mean, they have enough capital. If they want to go that direction, they will. And I do think it's all about cap rates, right? Because again, a cap rate assumes no mortgage. They're just paying cash. If they can truly get a 7 cap in single family homes versus a 3.5 or 4 in apartments, guess where they're going to go? I mean, it's just what's
the whole subscription model. We'll have subscription houses, subscription cars, everything else is subscription based, right?
Yeah,
so
you rent it for a little time. Yeah.
Yeah.
But again, what I think this means for single existing homes is you as an individual. And if you look forward 10 years and you see single family homes becoming a true like renter nation, the only answer in my opinion is go get your 4 as soon as possible. Lock in 30-year money, do the work, do a good or great deal. Because you're going to be really happy, right? I'm going to,
Now let's caveat that it needs to cash flow. So don't go out there and bank on, hey, this thing's going to appreciate, so I can be underwater. No, don't do that.
No,
you can pay whatever you want as long as it services the debt and returns on the capital that you're investing, that meet your goals. So if you don't need a return and you're fine breaking even on your investment, but the house covers itself, then that's fine.
Yeah.
And I'll tell you where a lot of the play is right now. Short-term rentals, man, are on fire
Yeah.
because obviously people can't travel internationally. So in this country, or it's limited, it's nuts right now. The area I came from, they are like full capacity, this week, when usually it's not that busy this time of year, all the way out through the rest of the summer. And if you're trying to book a vacation home at the beach in most areas of the country right now, good luck.
Yeah. I did a daily financial news about 3 weeks ago when Olivia and I booked our summer vacation. I'm like, folks, do it now because this is going to evaporate and it's gone less than a month later. It's crazy.
Yeah.
But to your point, the only picture in my book, page 18, says no alligators.
No alligators.
Right. No negative cash flow. Never, ever, ever. Right. Go buy positive cash flow, positive yield. Don't bet on appreciation. You don't get permission to be stupid just because the market's being stupid. Do the work, find the deal. But again, I think folks, go get your 4. Right. Go get your 4.
And here's the thing. So at the end of the day, when you pay that house off, or when you're renters, so here's what Michael's really saying. When the renters pay your house off and pay your mortgage off down the road, 10 years, 20 years, 30 years, whatever it is, it's going to be worth something, whether it's worth more or less than what you paid. The renters paid for it. They covered the maintenance, to a degree. I mean, as a landlord, it depends on how you write your lease, but hopefully you get a good renter that takes care of the property and does the little things. But at the end of the day, hopefully you've made a little money along the way, but you've got this asset now that is going to be worth something. Even if money means nothing, you still have something you can trade because people got to live somewhere.
Yeah. I really do think that the asset of the 2020s, is that a thing? The decade of the 2020s. It's easier to say the 1980s. This is the
20s. Yeah.
The 20s, whatever it is. The asset of the decade is going to be single family homes. Go take care of your family, do the work, no alligators, no negative cash flow. Let the tide raise all ships. And again, if people, this is not over. If they're truly getting 7 caps in single family homes and their options is a 3.5, some is good, more is better. So I expect to see more. I expect that 2% to go to 6, and it could go to 10, which would change the market, I think. Any closing thoughts, Greg?
That's it. Just, stay at it, get out there, keep looking at deals. There's deals in every market, every type, every class. You just gotta, the more competition, the more you have to make offers.
Yeah. Do the work. Absolutely. Thanks, buddy. This has been a great 3 sessions.
Yeah.